Hey guys, how you doing? I'm Kent Tilley, and before I start, you need to know that this video is not investment advice. Ryan put some disclaimers on there. This is my opinion about something that I see happening kind of in the world right now that I kind of want to just sort of warn against getting too excited about this advice, even though generally this is and has been good historical advice and it makes sense. Um, so I was thinking the other day about why I would be really worried about investing a whole bunch of money into the S&P 500 right now by taking a Vanguard or BlackRock ETF and just going all in on that sector, even though right now all of the people that you're following and a lot of really good, smart people with money are recommending this because generally speaking, historically speaking, the S&P 500 is a great investment and has been. It's diverse. It has 506 companies or whatever in the States that are very diverse. We all know that companies in the United States are born to make money. If some of them fail, a new one's going to replace them. Over the long term, the S&P 500 has been an absolutely amazing investment. But what I'm looking at right now is following what people are talking about and what they're doing. And whenever everybody is doing something, that's when you want to like pull back on the reins, in my opinion, because that's never good. Always comes down to Warren Buffett, in my opinion, his most famous saying, which is like, be fearful when others are greedy and be greedy when others are fearful. And right now, people are greedy towards the S&P 500 because the inflows into those ETFs are absolutely massive. And almost every influencer online that has now fallen apart and the good ones are left are saying go into the S&P 500 and this is going to be a great investment. So let's just look at what's happened since 2020 because everything has been just wild. How many of these sort of things have we seen where influencers were pushing everybody to do everything? The first one, toilet paper rush of 2020, that was really exciting. I couldn't tell if that was a bubble or not. I don't know if anybody's holding on to too much toilet paper still, but I'm sure there's people with basements full of toilet paper and they're just having toilet paper fights. Meme stocks kind of came next. That was like 2021. Those were intense. I didn't see any problem with those at all. They seemed perfectly legit. The companies that were worthless were now worth, 400 times what they're earning or whatever. That's no problem. Crypto was everything. Millionaires everywhere overnight. There was only 20,000 different cryptocurrencies. People are like, this is next level stuff. Yeah, they probably weren't all going to survive and didn't. You don't have too many crypto influencers anymore because they lost so many people so much money. NFTs, I don't know. Are you pumped up that you paid $600,000 for like an ape or whatever? That I could draw you one for like $6. I'll draw you one right now for $6 if you want to buy it. And then we've got sort of our last two. We've got real estate, especially in Canada, especially in Toronto and Vancouver, that has just been pushing up and up and up. And if you're not noticing that there's some breaking points potentially in there, then you're probably not paying that much attention. You can never go all in and take too much risk into something because you think it's guaranteed. And so just the same way as our real estate is not guaranteed to continually go up forever, I would be worried about real estate and Canadian banks because the banks make all their money off of the real estate and our debt. And if we can't pay it, they stop making money. And now let's get back into the S&P 500. So I was thinking about all the inflows going in and everybody saying, okay, this is now what I want to do, because there's a lot of smart people saying this is a very good investment, which long term, it is a great investment. It is. But when we're looking at things in a little bit shorter term, that makes a really, really big difference because everybody's saying, The S&P makes 11% a year or whatever, but that's not how it actually works. The averages start to work out that like that, but it is wildly different if I said, did you buy in 2000? Did you buy in 2007? Did you buy in 2009? If you bought in 2000 or 2007, your return since then certainly has not been that 11, that high percentage-wise. It has been much lower. But if you bought in, say, 2009, after the crash, then you have gone up dramatically and you've said, I'm the greatest investor of all time. I am amazing. And so I'm thinking about all these inflows and saying, okay, if and when there's the next correction, if that's a huge one, then what has happened is all of these 500 companies are more overvalued than everything else because all of the inflow of money is going into 500 companies instead of really diverse investments in different companies in different countries, different sectors, blah, blah, blah. Those ones will be undervalued because they don't have as much money flowing into them, but they might be really valuable. So if shit hits the fan, then I would suggest that the S&P 500 is going to get its ass kicked more than everything else, which comes back to why we need to have diversified portfolios. Should you have the S&P 500 in your portfolio? Of course you should. But if it drops 70% and something even stays stable, now you get the chance to move that stable investment and buy the S&P 500 at a lower price, which is why you want a diverse portfolio that is rebalanced. And if you don't trust me, well, Michael Burry yesterday just announced that he put a short option of $1.6 billion against the S&P 500 because he's looking at numbers a lot more clearly than I am. And all I'm ever looking at is human movement of money. And what's sort of the talk on the internet of what's happening and what are people doing and what are people saying to me to my face about investments and what to do. And anytime everybody's going all in on something, I would certainly suggest that you do not want to follow that herd. That's it. It's all very simple sort of rules. Keep it simple. Try, this book again, The Psychology of Money, one of my favorite quotes in there as well is, don't try and win, because when you're trying to win, then you're going to get huge losses. What you want to do is be above average over everybody else over time. And that way is boring. And you got to stay patient. And you got to be okay with the fact that you're going to talk to your friend that said that they just dominated last year. So anyway, there's my rant for the day. Give me your arguments in the comments if you want, if you love it, for sure, absolutely. It's not like I'm against the S&P 500. I think, America is born to make money, and they're always going to have companies that make money. Good long-term investment, but short-term, you could potentially get really hurt if you think that going all in on one thing is a good idea.